from you.
Thanks, Nitin. Let's participants, please ask your questions in the Q&A box. Nitin, as we wait for the participants to put in their questions, I think the question that I have in my mind, and I'm sure a lot of people have as well, is how long do you think this economic recovery will take?
I think that's a good question that you ask, and I think you have economists and everybody scratching their heads trying to figure out the right answer, and I don't think anybody has a accurate answer to this. But I think if I were to look at it, I would believe that once see, right now we are at a situation where while we have opened up and things are very mixed. For example, July was decent month, but that was because there was a huge amount of destocking that had taken place prior, and so there was stocking of channels that took place. August has been good, if you have seen from the auto sales numbers, and if you even go by the GST data that has come out at 86,000 crores, it seems to indicate, and by when we sort of got into COVID, we were close to about our GST numbers used to vary anywhere between a lakh and a lakh 10 or roundabout in that number. So we are almost 70-80% back in terms of our GST revenues. So my own belief is that as India is learning to live with COVID and is opening up, and I think by the fourth quarter, and hopefully if there's a vaccine by there, we should be there close to our run rate that we exited at. I think for corporates to get back to their original earnings that they had before the COVID crisis, I think it would be more like 21, 22. But on the other hand, one huge positive that I see is if you talk to most people, and I'm sure some of you out there would share the same experience, everybody seems to be saying they're working even more hard today when they're working from home, which essentially means productivity is going up tremendously from that. Now, where the pain is there is in the lower level jobs, where there is a lot more in the face physical presence, where lockdowns are having an impact. I think those will be the last to come back as such. So I think 21 and 22 is when we should be back to our peak where we exited at. But I think by Q4 we would be at that run rate.
Right, Nitin. We have a first question from Mr. Swapnil Shah. Kindly explain your exit criteria with examples.
Okay. So our exit criteria is essentially twofold. As I said, we continue staying invested in companies which are delivering numbers almost consistently, and we've had examples of that. However, where we find that the economic fundamentals are changing, so we will exit. Now, let me give you an example of that. Vaibhav Global, which we initially invested at 100 rupees, 112 rupees, gave us 5-6 times our money at that in the first round. Then we found that the business economics had started changing because competitors in the US had started offering an EMI-based product, even for a $20-25 product that Vaibhav was selling, which would significantly change and alter the dynamics as such. So we, at that point of time, exited. For the next 1 or 2 years, the company essentially went through a flattish growth period. By the time they were able to get this model in place, and when we saw that that model had started falling in place and growth started returning, we entered that back. But a change in business dynamics made us want to get out. The second is where we find okay, let me give you another example of a company where we exited. So we used to own Bajaj Finance. We invested it, very, very early, as the presentation showed. At a point of time, Bajaj Finance started trading at 6 times book. Now, in the past, my experience showed me that every time a company went and traded at such a rich premium to book, invariably there would be something in the business cycle or something in the business that would come and hit it. We were wrong, but in Bajaj Finance's case, actually that 6 times book multiple expanded to 10 times book multiple. But what we did was we sold our Bajaj Finance and we bought Bajaj Finserv, because it was our belief that through Bajaj Finserv we were not only owning Bajaj Finance, but we were owning 2 very great insurance franchises. In the general insurance business, Bajaj Allianz is a leader. It's got the best capital ratios you can see. And probably one of the few companies who actually makes business money on its underwriting. A lot of general insurance companies make money on the investment, not underwriting. Similarly, so we bought that, and that paid off, because not only did that did much better for us than Bajaj Finance. So that is another criteria. The third is where we find that the management are not living up to their promise, or they are not delivering. Another criteria is when we find that the business mode, or if I were to say the strength of the business, is becoming weaker. And how do we classify that? We look at working capital very intently. For us, companies who have less than 100 days working capital are the kind of companies we want to invest in. Any company which exceeds that means that it's losing its business competitiveness, or pricing power, and so on and so forth. So we will look to get out of that. If there is a company in which a promoter has gone and pledged more than 20% of his shares, we will get out of that company, because we as minority shareholders don't want to pay the price for a promoter's ambition if things go wrong.
Nitin, I have a question.
Yeah.
PE ratios of indices have gone back to pre-COVID time, that is closer to 30 against a long-term average of about 20. Now, if indices are overvalued by 50% of their long-term numbers, can we still find companies with 20% CAGR that can deliver similar returns to investors?
So when you look at PE ratios, Deepak, what very often happens is that markets are discounters of the future. When you go through a downturn, or when you have a GDP contraction and an earnings degrowth, suddenly the E becomes high and the P looks very high as such. However, what you need to look at is the P ratio on a normalized basis, because everybody knows that COVID as a incident is something which will pass. It might take another 3 months or 6 months, but the pace at which vaccines are being planned, in fact, in the US, they're already talking of launching one before the election, and so on and so forth. So, which means that the markets essentially look to discount businesses on their optimal valuation, not at the valuation that you show. So very often, if you would probably see when you take commodity companies, when the commodity cycle is down, their PE is high. When the commodity cycle is up, their PE is low. So P's can sort of give you a distorted picture of the markets as such. However, if one were to take, so for example, let me give you another example. Now, when we look at the market P, one of the largest contributors of the market P is Reliance, given the weightage that it owns in the market as such, in the Nifty especially. Now, today, you are really not seeing the value in terms of the profitability of the retail and the telecom business in its PAT. So the PE of Reliance might look high relative to its historic numbers. But historically, Reliance was being valued on its earnings based on it being an oil and gas company. But today, it is being valued for the value of the assets that it has created in terms of the brands that it owns in the retail side, or the number of subscribers and the platform that it has set up. That's the reason you have players like Facebook and Google and all ready to come and pick stakes in that company. None of that gets reflected in the E. So, in some of this sense, that P becomes of no use, and hence. But to answer your question largely, I think the P looks high because right now you're seeing a 23% contraction in GDP, and hence the earnings degrowth, making the P look high. What you need to look at is what would be in a normalized state, the earnings, and then look at the P.
Right.
Right.
Nitin, the next question is from Mr. Piyush Motwani. Are we seeing a strong correction in the market in the next 1 to 2 months? With huge job cuts and a lot of people now looking at reducing their spend and money not easily changing hands, how long do you think the current market should hold ground?
So, Piyush, the point is, as I highlighted to you, trying to forecast markets is really a thankless job. And, it's a full-time business for channels like CNBC, but I don't think anybody has got the markets right in terms of people have found the US market overvalued and it's run up, and you would have possibly missed one of the best rallies in the market. The more important point to understand, Piyush, is that I will try and answer your question also. But what I'm trying to understand is, Piyush, if we obsess too much about the markets, we're not going to make money in these markets. The focus has to be on what you own in your portfolio, because that is what is making money for you. The market, when you take the Nifty 50, okay, and you were to take out the impact of, let's say, a Reliance or a Infosys or some of the other tech stocks out of it, is probably trading at a very low level than its historic high. So there are these, similar is the case globally. So there are these 5 or 6. But if you were holding these 5, 6, you've done far better than the market. So are you happy thinking of where am I? Because you're not buying the market. Unless you're a trader and you're trying to trade the Nifty, you're not buying the market, you're buying stocks. So if you were owning Reliance in your portfolio or Infosys in your portfolio, you'll say, fantastic, you know what? I'm very happy. I can see visibility. I can see what's happening. I think that's the point. Now, on the broader market, if I were to tell you, let's look at it this way. With global economies in trouble, central bankers actually had learned the lessons from 2008. And they, in fact, all of them together reacted with a speed and alacrity which is not seen before. The kind of money that was pumped into these markets, or the liquidity that was provided, and we have that in a slide separately in another presentation, was absolutely unheard of. Now, when you have that kind of money and with an intention to declare that, look, we are going to be out there ready to buy and support any security, which means they've actually announced that they're even ready to buy junk bonds. They're ready to buy even stocks at that point of time when there was so much of panic in the market. So that is what is called as the Powell put. So when you have a Powell put and you have so much of liquidity ready to come at you, I don't think the short sellers will have the capacity to stand against the US Fed. So if and when the correction were to happen in the markets, my own view is it could be a 5 or 10% correction that you could see in the market happening. I don't see us going back to the levels that we saw in March. I don't see us going back even remotely close to those levels out there because of the sheer Fed put. Further, there is a stated objective that the US Fed has put out stating that they want 2% inflation. Now, this is fundamentally very different from what we have ever discussed in the past, where inflation targeting was a central banker's role. Today, the central banker is saying, I want a 2% inflation, which means he's going to keep more and adequate liquidity in the markets. All of this at a time when interest rates have been kept at close to zero means there is going to be, people are per force going to have to look for and hunt for returns and are going to move towards risk assets. So with that kind of support there, I really don't see markets coming off big time. Well, yes, the economy is in the dumps. So I'll tell you what will happen. But markets, as you know, are forward discounters. So you will probably see the fact that economy recovery. So when we came out of the lockdown, there was this initial enthusiasm, whether it's V-shaped, U-shaped, W-shaped, whichever shape you want to call it. The markets actually came back strongly. But if you've noticed over the last 1 month or 1.5 months, the markets have actually tended to trade in a very narrow range. They have started consolidating at this. I think till the time COVID or the vaccine is not out and COVID is not addressed, we will see the markets continue to remain like this, with a little bit of a firm upward bias. Once COVID is out of the place, now people are no longer worried about that. And the central bankers feel that their job of trying to support the economy through liquidity measures is no longer needed. You will see the market correct. So in that sense, I think it will be similar to what we saw in 2016 in the drawdown that you saw. That's where the Fed actually changed its tack and said that we are now going to reduce, we're going to increase interest rates. That's when you saw markets sneezing and correcting. So I think we are going to see a similar scenario. We are going to see a couple of other things which will happen, and I think we are going to see the US currency or the US dollar becoming weaker, purely because it's a pure demand supply. You have so much of supply that has come into the market of the dollars. You are actually lessening the value of that asset class as such. So that could have ramifications on businesses and industries and asset classes also. So it's a very complex dynamic, but again, I said, you could read and read and read and read and hear and hear and hear and hear. Frankly, you will be no wiser. At least I am no wiser after having heard all experts talk. So again, that's when I said, we went back to our study and we said, look, ultimately हमको तो पैसा बनाना है और हमको देखना है पैसा हमारा कहाँ बनेगा, किस type of company या asset में बनेगा. And so we would rather focus our time and attention on doing that.
Right, Nitin. The next question is from Mr. Pandya. How do you decide the percentage allocation to individual stocks in your portfolio?
So, Mr. Pandya, as a rule, we don't go beyond 5% for almost 70-80% of the stocks that we own in our portfolio. So our ideal scenario is 20 stocks with 5%. In exceptional cases where we are very confident of a particular company and its prospects, we possibly go to 6% as such. But generally, that's the broad thumb rule in which we operate.
Right. The next question is from Mr. Kunal Joshi. Looking into the past 6 months, no tech stocks in the portfolio. I mean, we had only one tech stock that we've disclosed.
Yeah. So, Kunal, we missed the tech rally. Primarily because none of the tech stocks really satisfied our criteria of growth. They're great ROE companies, great balance sheets, but from a growth perspective, if you really see the number, the growth number has been 9, 10 or 11% from a top line perspective, and maybe a little more. So they did not satisfy a criteria of the doubling in 4 years phenomena for us, and hence we were not able to go and invest there. Could we have gone and invested just as we invested in gold in some of these companies? Answer is possibly yes. But not having tech has really not impacted us from a performance perspective.
Right, Nitin. One more question that I had was on gold. Where do you see gold headed? We just added gold in our portfolio recently during COVID times. How do you see gold going forward?
So gold, as you know, traditionally has been an asset class where people go to when there is inflation or when there is turmoil and uncertainty. So I think gold did well. And then, once gold starts doing well, it just is self-fulfilling, and more and more people climb on board the bandwagon and ride it. So I think gold started doing well because of COVID and all the uncertainty. And right now, most people are getting into gold for the same reasons as I told you, which that because there's been so much of supply of liquidity and currency, the dollar in the world, there is a fear that you are going to lose the value of the dollar. And hence, a lot of large investors globally have taken positions in gold to protect themselves. So gold is used more to protect. Gold is not a growth asset. Gold is as an asset class is often used to hedge yourself or protect yourself. And given the current scenario, that's what investors are doing. And if you see gold over a period of years and cycles, it follows a cycle where it's got a step function. It remains flat for long periods and then it goes up and then it's flat again. So I think we are in that cycle right now where it's on that uptrend. How much up can it go? I am no authority on gold. Like I said, I own gold because I see the fact that I see inflation coming back over a period of time because of the sheer liquidity that is there in the global economy, and also because of the uncertainty that prevailed. Once we are out of this, I will probably be better off investing it in corporates who are growing and who are delivering profits.
Nitin, I have a question, Sanjeev here.
Yeah, hi Sanjeev.
Yeah, especially like when it comes to 4 years and 5 years, 3 years and 5 years kind of CAGR compared to mutual fund.
Right.
How do you fairly kind of outperform the market? Because there is a comparison happening since it is a specialized kind of a portfolio. Right. But by and large, if you look at the performance, there is no any much difference.
So Sanjeev, from our perspective, why this happens is very simple. When you are a mutual fund, you typically own anywhere between 70, 80, 90, or even 100 stocks in your portfolio, right? Typically, if you see mutual funds, they don't own more than 2% or 3% weightage in any single stock. By that very logic. Now, it's very, very difficult to find. So like I highlighted to you, when we looked at the drawdown cycle, we found 100 stocks in that out of the 500 who did well and delivered that number. It's very difficult for you to be in a mutual fund to say that I will find all those 100 stocks. You might have 20, 30 or 40 of them, but there will be a good 50, 60 of them which are not doing well and not performing well, dragging down the overall performance. In our approach, which is a concentrated approach in that sense, we own about, it's not, we own about 20 to 24 stocks at any given point of time. It makes it a little more easier for us to be selective and choosy and choose those high growth companies. If you picked up any mutual fund portfolio, you will probably find that the average growth of those companies will almost be replicating the index or the earnings growth of the overall index, or will be slightly around it or more than it as such. But for us, we can, because we are so focused and so this thing, we are able to do it. The other problem that a lot of mutual funds have is that because their size being what it is, they are perforce supposed to, they're forced to take bets in, like the largest mutual fund has no choice but to go and buy a L&T or a SBI in their portfolio, because if he has to allocate a huge sum of money, he cannot not have some of these large weights. Now, those companies have not given returns as such. So our size, our concentrated bets enable us to do that.
Yeah, I got it. Basically, the question was from a distributor on a comparative note. how do you guys, outperform the mutual fund on the, 3 years and 5 year scenario? I think probably, as per your answer, it will stay with us for a longer time. Probably we'll get to see the actual better returns compared to what mutual funds are giving.
Yeah, that's because of, as I said, I need to only find 20 ideas. I don't need to have 90 or 100 ideas. And believe me, 20 ideas itself is tough. So I don't really, for a mutual fund manager, I only sympathize for him to be able to find 80, 90 ideas to be able to beat.
True. Absolutely. Yeah. Thank you.
Nitin, we have a next question from Niraj Shah. Any reason why we don't have Reliance in our portfolio?
Good question, Niraj. We missed it. But will I look to buy Reliance going ahead? Answer possibly is yes. When we think that we get it at an appropriate price. But right now I don't want to. Let's look at it this way: that Reliance has seen one leg of a good rise. It's right now at a stage where it is really consolidating what we have seen. But I think if I take Reliance with a 3 or 5 year picture, I think yet it has got a long way to go. So we will probably look at it, but we missed this rise.
Nitin, that was the last question.
Okay.
Sorry, we have one more question. Sorry. Piyush Motwani writes in, what's your take on Vodafone and Yes Bank?
What's your take on Vodafone and Yes Bank? It doesn't, for us, at the portfolio level, they don't satisfy the criteria that are laid out for you as such, which is growth and quality of earnings. If you're asking me my opinion outside of the fact, to me, I think Vodafone has some tough challenges ahead of it in terms of the kind of debt that it is sitting on and the obligations that it faces post AGR and otherwise also. It will have to raise rates, but it can only follow others in raising rates. It cannot set the precedent by raising rates, because if the other two don't raise rates and they go and raise rates to survive, there will be a migration of customers. So Vodafone, if you ask me, is a wild card play that you play. Yes Bank, I think, has gone through all the challenges. It is now quasi owned by SBI. It's got capitalized. It's never going to be the Yes Bank of the past, which was driven by this entrepreneur who wanted high growth at all given points of time and did anything and everything to achieve that growth. It's now run more by bankers from SBI and others. So it's going to come back. But if you ask me at this price, about at around 15, 16 or whatever roundabout, I find it's fairly valued.
Right. Nitin, last question. We have a question from Mr. Shah. How do you rate Vaibhav Global as a promoter? He has heard some cases that happened back in 2006, and he wants to know what's your take on the Vaibhav Global promoter.
So I'll tell you, we are aware of those cases, and the promoter himself has come out and talked about it at different presentations and forums. So it is not something he did raise venture capital money from PE funds way back in 2006 to grow the business, and then they got hit by 2008. It is a testimony of the fact that those PE players have stuck by him, which incidentally can also sit on his board. We think they have a great business model. My interactions with the promoter at any given point of time have shown me a person who, if I were to say that, has seen through tough times, is very circumspect in terms of what he talks and promises, is very measured runs a very sensible business, and it's, and now let's look at it differently, right? So come down to what are the economics of the business. In Weber Global's case, it's a business which has great economics. How? It's a business which enjoys almost 60% plus gross margins. It's a business which has got a huge leverage on fixed costs. Now, I own 2 television channels, one in UK, one in US. I have great penetration. My fixed cost is my content cost, which is my largest cost component. As my sales keep on growing through the channel that I've created, which includes sourcing, telecasting, logistics, right? An ability to choose the right product. Now, as I start pumping in more and more, my broadcasting cost, which is a large component, remains the same. And my margins just keep on improving. So when I have that kind of margins in the business, and you start seeing huge cash flows, the business has a 40% ROC. The so-called doubters in the past who talked about that whether this cash is genuine or not, promoters are paying out hefty dividends, buying back shares, returning cash to the shareholders as such. So when you have, and importantly, it's a huge flow positive business. You can't argue with business economics. And frankly speaking, which promoter does not make mistakes? Even the Tatas have made mistakes and more as such. But here is a promoter who has gone through the worst, and he talks about it openly. He's not averse to it. He acknowledges his mistakes. But in the last 10 years, if you see the way he has run his business, he has paid off every single paisa of debt as such. I think he's doing all the right things. And coupled with the fact that the promoter doing the right things, being shareholder friendly, and a great business model.
Right, Nitin. I think you can add on how Weber dealt with the pandemic.
Yeah. Why don't you talk about it, Jay?
Yeah, so Weber showed extreme agility during the pandemic. Here was the business channel that was only selling jewelry. They moved from jewelry to lifestyle. In fact, if you see over the years, they were doing only 5 to 10% lifestyle. They have now 30 to 40% lifestyle products. In fact, they're using this channel to sell all sort of lifestyle products, right from bags, other things like, they were selling even pasta through the channel. So that gives us great visibility on, here's a promoter who's willing to use this channel, and there's great operating leverage that the business enjoys. So he was not afraid to sell PPE equipment to his channel. He was selling, anything that, they run on a pull strategy. So whatever the customer wants goes through the channel. Nitin?
Yep.
That was the last question.
All right. Great. Thank you, gentlemen. If you have any questions, you can reach out to Deepak or Sanjeev. And we are always there to clarify your doubts and answer your questions.
Thank you, Nitin, for that informative and detailed presentation and session. I request all the participants, if you have any further questions, you can still mail it to us. We'll be in touch. And do take advantage of this phenomenal PMS called SATCO Growth and Moment. Thank you, everyone, for joining us today. Have a good day.
Thank you.